Welcome back to another episode of Travis. Can I have this? We have a very fascinating topic for accountants. We have new tax law, and this is a big deal for everyone. You're probably listening to this as a podcast because that's what most people do, even though I record the video. If you happen to glance at the video, you will notice I am wearing a very patriotic shirt. I'm not wearing this because I'm in love with this tax bill, but we have a law passed in the United States of America, and I'm going to celebrate naturally by wearing the most American thing I have, which is a soccer World Cup jersey from 2014 World Cup. We did pretty good in that World Cup, and so I'm wearing that jersey, but this is a big deal. The one big beautiful bill was signed on July 4th, just a few weeks ago, by President Donald Trump. There are a lot of things politically we can say good or bad about this bill. We could even look at this bill from a macro level and say, is this really good for the country? But that is just too overwhelming. I won't give an opinion on any of those things. But what we have to do is this bill has passed. So what are we going to do about it? And today we're going to dive into this bill and what it means for doctors. I'm going to do two parts. Today, I'm only going to talk about business owners. If you own a practice, what does this bill mean for you? And in part two, we'll talk about if you are a individual, if you're a human being, what does it mean for you? And there's a lot of things in both of those lenses that we'll talk about. But today, let's get into the one big beautiful bill and what it means for practice owners. Let's go. All right, a few items of groundwork. The name of this bill is One Big Beautiful Bill. There's lots of people that don't think it's beautiful. It is big, but there's a lot of people that don't think it's beautiful. I heard that the official name is not actually One Big Beautiful Bill, that there was a Democratic senator that tried to change the name, but I'm still seeing the One Big Beautiful Bill on the legislation online, so I'm not exactly sure with that, but there are nicknames out there. OB3 is a popular one, so I might be calling it OB3 on this podcast, referring to this One Big Beautiful Bill. Another thing to understand is anytime a tax law is passed, they don't ever say, well, this is good for doctors or this is bad for doctors. But when I read it, I always read it, okay, what does this mean for doctors? And there usually are a lot of things, like good things, that are rolled out in a tax bill, but they go away if you make a certain amount of income. And it always seems like doctors make just over that much income and they don't get that good thing. And I honestly think that's very much intentional, that they are relying on the income class that doctors fit in to pay more in taxes. But there are still some good things in this, but we'll look at it from specifically a doctor's lens. The other thing I want to talk about before we get into some of the details is a lot of this bill that was passed is anticlimactic. There are a lot of things that you had in the tax law last year that they made permanent in this bill. So it means that things that you had last year are not going to change. And those things are generally good things, but it's not going to feel like, oh, there's not these massive changes. There's this big, massive bill. Okay, what's going to change? Well, a lot of it is just that there's no change. And what was going to happen is that a lot of these provisions in the tax code were passed in 2018 by a bill called the Tax Cuts and Jobs Act. That was Trump's first big tax overhaul in 2018. And all of those things were going to expire in 2015. So you've been living in a pretty good tax code for the past several years, but that was supposed to end at the end of 2025. But it's not. And a lot of those things got made permanent. So it just doesn't feel like, oh, there's all these great, wonderful things because of this tax bill. But just know it would have been a lot worse without this bill. That is for sure. Okay, I'm going to talk about two big things for businesses and four small things for businesses. All right, big things. The first big thing, and this is the headline of the One Big Beautiful Bill, or not headline, but something that was consistently brought up, is bonus depreciation is 100% and it's made permanent. And that's a pretty big deal. So last year, 2024, bonus depreciation was at 60%, and it was supposed to go down even more. I think it's supposed to be 40% in 2025. But you get 100% bonus depreciation. What does this mean exactly? This means if you purchase a large equipment item, usually think in your practice, a dental chair, a sterilizer. You do, some big expenses in your practice. Think of like physical, tangible things, or you buy a car. That's another popular one. And let's just say you buy $30,000 scanner. You can get scanners less than that. I'm sure you all know that. $30,000 scanner. And the traditional tax code says you have to write that off over 5 years. But then they introduced this thing called bonus depreciation, and you could accelerate that. Well, now you can write it all off in the current year. Now, you might not want to do that, but having the option is a good thing. Now, in order to get this bonus depreciation in 2025, the item needed to be placed in service after January 19th of 2025. So there's these 19 days in 2025 where if something happened to be placed in service in those 19 days, you don't get 100% bonus depreciation. Why January 19th? Because that was Inauguration Day when Trump became president. Now, the language on this is interesting, that it needs to be placed in service. So if you happen to have purchased something and paid for something, let's just say on January 5th, you want to make sure it wasn't placed in service, wasn't actually used until after January 19th. How is the IRS going to know exactly when you bought it, when you placed in service? It's going to be hard, but you want to have things placed in service after January 19th, hopefully as much as possible. Now, another question that comes up with bonus depreciation is there's another form of depreciation called Section 179. And we could have a whole podcast episode that would put you to sleep talking about bonus depreciation and Section 179. Maybe you're already asleep, and you're going to have good dreams because it's good news we're talking about. But you might be thinking, okay, I hear bonus depreciation. This is a big thing about this bill, and it's back and it's 100%, like big whoop, because I've always had Section 179. Like, what's the difference? Why does it matter? There are a lot of differences between these. There are some good things about Section 179, and there are some better things about bonus depreciation. But I'll just say there's two reasons why you want to have bonus depreciation in your back pocket. The first reason is if you have basis issues in your S corporation. Now, that might not make sense to anyone. Again, that's a whole nother topic for another day. But basis issues are very common in S corporations, especially if you're in the early stages of practice ownership. And so Section 179 causes more issues with basis. Bonus depreciation does not. And so there's good benefits to be able to have bonus depreciation. Another reason that we like bonus depreciation is for your automobiles. If your automobile is more than 6,000 pounds, bonus depreciation kicks in 100%. Section 179 does not. Section 179 gets capped at a certain level. So if you have basis issues or if you're thinking of buying a vehicle, the bonus depreciation is really sweet. And we usually try to take that bonus depreciation first if we can. Again, there might be reasons why you don't want to do bonus depreciation, but just having it in your back pocket, having it as an option is a good thing. So that's the first big thing. Bonus depreciation is back 100%. Good for everyone. All right, next big thing is this thing called QBI. QBI stands for a qualified business income deduction. QBI is made permanent. So this is something that was introduced in 2018 with Trump's first tax bill. It was supposed to expire at the end of 2025, and we're keeping it around. And what QBI is, many people know, but the simplest explanation is if you have an S corporation, a flow through entity, well, an S corporation or a sole proprietor, you take your net income, so your profit at the end of the year, and you take 20% of that, and that then becomes a deduction or a write off. So it's basically this free write off that you get in your business, which is great. But there's two caveats I want to talk about with QBI. And these things are things that you want to have on your radar before the end of the year because you need to make sure you know what these numbers are. The two things you need to know with QBI is you as a doctor are in a special class that once you have more than $400,000 of income, and this is total income, this is your business plus your personal, your spouse, all of your income together. If you make more than 400,000, if you're married filing joint, it's different if you're single, but we'll use 400,000 for a married person. If your income is more than that, you start to lose out on this deduction. If your income is more than 500,000 or 550, I think, you entirely lose out on this deduction. So 400,000 to about 550 is this range where you start to phase out. If you make more than $550,000, you get $0 of this QBI deduction. So it's basically worthless to you. If you're single, that range is 200,000 to 275,000. So if you make more than 275,000 as a single person, you do not get to participate in this qualified business income deduction. Now, why is that important? Well, if we're getting close to the end of the year and you're close to this QBI threshold, you may want to consider purchasing a scanner or a cone beam or something and using that bonus depreciation to get you into that QBI range for that year, especially if you're somebody whose income is rising, consistently going up. You may want to try to get into QBI while you can before you get into super high income, and it might be too hard to get into that QBI category. So definitely know what your QBI number is. So that's the first thing. The second thing is for S Corp owners. If you have an S corporation, you have to pay yourself a salary. And typically you want to pay yourself as low of a salary as possible. But there is a caveat that the salary that you pay yourself reduces your QBI income number, which ultimately reduces your QBI deduction. So this, in theory, you would want to, again, pay yourself as little salary as possible so that you can keep your QBI as high as possible. But there are scenarios where if you paid yourself more salary, it could actually increase your QBI. It's because of how this QBI is calculated. It factors in your wages as well as your business profit. And so it gets a little quirky. And I was thinking, I had this crazy idea of like going through an example verbally today. And I think that would just be terrible. It's a terrible idea. But I have it up here. And I can tell you that there are scenarios where you could pay yourself more wages and increase your QBI. And there are scenarios where you could pay yourself less wages and increase QBI. So it's a quirky thing, and you want to be strategic going in to the end of the year and know what you should pay yourself as far as salary goes, because it can be really tricky. So know what your QBI number is. That is permanent. That's a thing. We didn't like going into this year. We didn't know how big of a deal that would be. It's a big deal and it's going to be forever. And know what your wages are, how much you're paying yourself as wages. That is going to matter. That's going to be a big deal. Okay, those are our two big things. And bonus depreciation was not at 100% last year. It was a few years ago at 100%. And QBI existed last year, right? So like, again, those are not things that like are that different from last year, but they're things I think in the accounting community, we always knew that they were temporary. Like this QBI thing was temporary. I know for a fact there were accountants out there who were like, I'm not going to master this because it's going to go away. Now they can't do that. You got to master QBI. All right, let's talk about four small-ish things. And depending on your scenario, they may be big for you. I have a client. The first one is big, but I only have one client who that is a big deal. All right, so the first one is R&D expenses. So R&D stands for a research and development tax credit. If you are a doctor and you are getting the R&D tax credit, it's because you are a very unique doctor and you're doing some very special things, or you're just a very aggressive doctor. And that's okay. There are legitimate opportunities, I think, as a doctor to take the R&D, even if you're not that special, doing like innovative, groundbreaking technology in your specialty. You could still argue that you could take the R&D tax credit, but I think it's a little bit more on the aggressive side. I'm not judging. I'm just passing along my opinion on this. But typically the R&D tax credit is for businesses who are innovating, and you're in America and you're creating new products. Usually software or manufacturing related is typically who the credit is for. But some doctors do get this credit or try to get the credit. Well, typically this is a big credit, but you have to spread it out over several years. We call that amortize it over several years. So you'd do this calculation and you'd calculate your R&D credit to be $200,000, but you got to spread it out over 5 years, which is not bad, but they changed it to be you can recognize it all in the current year, which is a big deal. So if you've historically been amortizing it, you can accelerate it this year. You can go back and amend your tax returns if you want to. There's several options if you are getting the R&D tax credit, but I expect some big savings, and you got to have a lot of strategy around this to know when you want to recognize those deductions. All right. Another smallish thing, I think this is maybe the smallest of the smalls, is Section 179 depreciation, which we talked about a little bit earlier. Section 179 used to have a cap that you could only take $1 million of Section 179. Now you can take $2.5 million of Section 179. Oh, that is great news for basically no one. I mean, who was really capping out the $1 million of Section 179 depreciation as a doctor? I didn't see very many. Maybe, in the DSO category. But for most solo practitioner doctors, this doesn't really change anything. Another smallish thing is the employee retention credit, ERC. The thing, I spent a couple of years of my life just doing ERC, so I probably talk about it more than I should. Most of you probably don't care. But if you got the employee retention credit, just know that you're probably in good shape. What came out, there were a lot of people who abused this credit, who basically got the credit and they should not have gotten the credit. And for the past couple years, there have been bills circulating Congress. None of them passed because it was an election year, divided, House, Senate, whatever. But there's a lot of enforcement of canceling ERC or extending the time that we could audit ERC. And basically what's happened is if you filed for the employee retention credit in quarters 3 and quarters 4 of 2021, you could still get audited. There's a 6-year statute of limitations on that. So we're looking potentially through the end of 2030, depending on when you filed it. You could get audited for those quarters, but most people didn't file for those quarters. You probably shouldn't have unless you were a startup. Most people filed for ERC in the years 2020, maybe early 2021, and most of you probably have your checks by now. And if that's the situation, then you probably will not get audited. So even if you felt like maybe later you learned you probably shouldn't have gotten your ERC, but you got it, you're probably in safe territory, assuming that there's no fraud, right? Taking an aggressive position is different than taking a fraudulent position. But also, if you submitted your ERC paperwork and you haven't gotten the credit, you'll probably still get the credit. We are still seeing those get processed. If you ever have any specific ERC questions, always feel free to reach out, because I decided to become an expert in something that is expiring entirely, which is super cool. Okay, another small thing. Are we on my fourth? Yeah, this is my fourth small thing. So we already did 2 bigs, 3 smalls. We got one more small thing. This is a good one. I like this one. So there's a rule that if you have a business and you pay somebody more than $600, you need to give them a 1099 at the end of the year. If you don't, you can get in trouble. And this is a big pain in the butt for a lot of practice owners. Like, you'll pay a vendor, someone to come do landscaping or something, and it's more than $600 by the end of the year, but you didn't get a W-9 from them, and you got to prepare a 1099, and your super annoying accountant is bugging you because they're trying to protect you. They don't want you to get fined, and they're saying, hey, we got to give this 1099 to this vendor. And it's just awkward when it's 9 months after the fact. Anyways, $600 limit. I'm going too far on these 1099 rules. It's now $2,000 starting this year. That's fantastic. So you do not need to give anyone a 1099 unless you've paid them more than $2,000. Now, there's other nuances to the 1099 rules on who you're paying and whatnot, but just know this $600 rule got changed to a $2,000 rule on who you need to give a 1099 to, and it will be indexed for inflation and things like that, and it will change over time. But there you have it. Those are the things. If I was a business owner, if I was a practice owner, those are the biggest things you're going to want to know. And it might feel a little anticlimactic, but it doesn't change the fact that going into the end of the year, you should have a good idea on what your numbers are. Look at QBI, look at your bonus depreciation, look at all of those things to know if you need to do something before the end of the year, and act accordingly. Thanks so much for listening. And next time, we are going to talk about the One Big Beautiful Bill and all the things that matter for your individual tax return. Thanks so much. We'll see you then.